Hey everyone, and welcome to The Explainer. I am so incredibly thrilled you're joining us today because we are diving into a truly bizarre paradox. It is absolutely defining the US economy right now in mid 2026. Basically, on one hand, you've got everyday Americans feeling the very real pinch of rising costs, draining their bank accounts just to get by. But then, on the exact same day, corporate America and the stock market are absolutely roaring. Shattering historic records left and right. So how in the world can both of these realities exist at the exact same time?
Okay, let's dive into this because this split screen is just jarring. Main Street's consumer savings have tumbled all the way down to a 4-year low, but then Wall Street is over there throwing a massive party with the S&P 500 hitting these incredible new highs. It's like we are literally watching two entirely different economic stories play out simultaneously. To truly grasp what's happening to our money right now, we need to unpack both sides of this divide. So let's start with part one, the consumer squeeze. Let's take a look at what everyday folks are actually dealing with.
Now, 3.8%. That number right there is the headline. Personal consumption expenditures, or PCE inflation, jumped to 3.8% in April, and according to the Bureau of Economic Analysis, that is the fastest pace of inflation we have seen in 3 full years. Just when everyone kind of thought prices were cooling down, bam, they flared right back up. But, it gets even trickier when we look under the hood.
You'll often hear about core PCE, which is the Federal Reserve's true North Star for tracking inflation. Even when you strip out those really jumpy, volatile costs like food and energy, this metric is still running uncomfortably hot at 3.3% year over year.
And this brilliantly illustrates exactly what that means for regular people. The U.S. personal savings rate has completely plummeted down to just 2.6%. Because inflation is just stubbornly refusing to drop down to the Fed's 2% target, consumers are literally being forced to dip into their financial safety nets. People are draining their rainy day funds just to keep up with the basic everyday cost of living.
So what's driving this renewed squeeze on the wallet? Well, there are a few major factual drivers at play here. First up is geopolitics. The ongoing conflict in Iran has seriously disrupted global energy markets, and that's pushed gas prices up over 50% since February alone. Second, we have policy changes. We're seeing broad price pressures ripple all the way through the supply chain due to the newly implemented Liberation Day tariffs spearheaded by President Trump. So you have this perfect storm of pain at the pump and pain at the port, which ended up dropping real disposable household income by 0.5% in April.
Beth Ann Bovino, the chief economist over at U.S. Bank, sums this up perfectly. She points out that the Fed simply cannot ignore how significantly these high prices have eroded our purchasing power. And this puts the newly formed Federal Reserve, under its new chair, Kevin Warsh, in a really tricky spot. Because despite all the political pressure to cut rates, the sticky inflation data is keeping the Fed firmly locked into a strict wait-and-see mode. And naturally, all of this economic strain is showing up in how people actually feel. Consumer confidence is softening, right in tandem with these persistent price hikes. It makes sense, right? When it suddenly costs you 50% more to fill up your gas tank and your grocery bills definitely aren't shrinking, everyday confidence in the economy takes a massive direct hit. So what does this all mean? This brings us to the million-dollar question. It's honestly the most perplexing part of this entire explainer. If everyday consumers are getting financially squeezed, draining their savings, and feeling super pessimistic, why on earth is the stock market completely ignoring this and soaring to the moon?
Well, that brings us to part two, the Wall Street boom. Let's shift gears and look at the corporate side of things.
Since late March, the broader market has staged a sharp 13% rally, and the major financial titans think there is still plenty of room to run. Goldman Sachs research forecasts the S&P 500 is going to reach 7,600 by year end, but FactSet goes even further than that. They're showing a median target price of nearly 8,700. Wall Street analysts are basically looking right past the consumer struggle we just talked about, and they are hyper-focused on corporate profitability. And here is the shocking number their optimism is rooted in, 28.4%. FactSet forecasts that for the first quarter of 2026, S&P 500 earnings grew by an incredible 28.4%. If that actually holds, it marks the highest earnings growth rate reported by the index since the end of 2021. So corporate profits aren't just surviving right now, they are absolutely thriving. Which brings us to part three, the AI earnings engine. This is the big secret weapon. Artificial intelligence is proving to be Wall Street's ultimate shield against inflation. Just let this staggering figure sink in for a second. $670 billion. According to Goldman Sachs, that is the projected 2026 capital expenditure by just the largest cloud infrastructure companies alone, all going toward AI. It's this wild irony. While folks at home are stressing over the price of a dozen eggs, corporations are out there dropping $670 billion on data centers to build out AI.
So, the crucial point is, AI isn't just some tech buzzword anymore. It is a fundamental engine driving the entire market's success. AI-related investments alone are expected to be responsible for roughly 40% of all S&P 500 earnings per share growth this entire year. It's a technological tailwind that is single-handedly pulling the broader market upward.
Now, what's really interesting about this is how incredibly top-heavy the S&P 500 has become. NVIDIA alone holds an insane 8% weight, followed closely by Apple, Alphabet, Microsoft, and Amazon. Because these specific tech megacaps are seeing such massive upward revisions to their earnings estimates thanks to AI, they actually have the sheer size and momentum to drag the entire index into record territory, completely regardless of what's happening to smaller companies or the average consumer.
And aside from the AI boom, Wall Street is riding a few other highly favorable wins right now. First, corporate actions are speaking volumes. Companies have authorized a record $422 billion in share buybacks this year, which shows immense internal confidence. Plus, analysts note that the market is already pricing in optimism around proposed corporate tax breaks from the administration. Those policies give major investors confidence that corporate profitability will stay protected, even if inflation stays sticky.
All right, part 4, navigating the divide. Let's bring these two totally different narratives together.
Economists are calling this a severe K-shaped economy. Rather than everyone moving in a unified trend, we're seeing an aggressive upward trajectory for mega-cap tech and wealthy investors. That's the top arm of the K. And it is completely decoupled from the downward slope of everyday wage earners who are just battling inflation, the bottom arm. The U.S. economy isn't doing just one thing right now. It's literally splitting into two different directions based entirely on who you are and where your money is.
But hey, a quick word of caution here. Even the soaring top half of this K-shaped economy faces some serious balancing acts ahead. Goldman Sachs and others are pointing out some very clear risks. For one, 30-year Treasury yields have spiked to 5.18%. And when yields get that high, bonds start looking really, really attractive compared to stocks. We also have ongoing, totally unpredictable geopolitical volatility from the conflict in the Middle East. And finally, the Fed has to navigate its interest rate decisions right in the middle of a highly charged midterm election season, trying to balance crushing inflation against the risk of hurting growth. These are the major macro forces tossing your 401k around. Which leaves us with this final, absolutely vital question as you think about your own financial strategy. We are quite literally living in a tale of two completely different economies. One is constrained by the hard reality at the grocery store. The other is riding a multi-billion-dollar wave of technological transformation. As you look at your savings, your career, and your portfolio, which one are you investing in? Thank you so much for exploring this crazy data with me today. Keep asking great questions, and I'll catch you on the next explainer.